Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, New York City, we have Peter Borish. He's the chief strategist over at Crude Group. We're going to take a look at underlying deflationary pressures, a macro overview of the market. We're going to drill down into the 6 C's in the commodity space. It's great to have you with us, Peter. Thanks for joining us. And let's talk about that, some of the underlying pressures that you're seeing in the market.
Well, we've seen a supply and demand dynamic where technology's improved, so you get more out of it. Demand improves on the other side because you're using it more efficiently. So that combination, continue with the slowing economy. Remember, GDP growth last year was the slowest in 3 years, leads to underlying deflationary pressures. Add on top of that, the virus, which has essentially shut down the second largest economy, and you're seeing all these charts of you had a rally when the Fed cut, and now they're all giving it all back.
Yeah.
And some more.
Well, Fed can't do much to stop the coronavirus, can't pump money into that. All right, let's take a look at the 6 C's of commodities. The first one here, we have crude. Explain the differences between each different one, what you're looking for here.
Well, crude is particularly weak because it's breaking new lows, as I was just saying. Some have retreated, but this case here, it's a perfect example of supply and demand. Everything that we've done on a regulatory basis enables you to get more supply out of the ground. But everything that we've done from a climate change basis is trying to use less of it. Economics 101, more supply, less demand, boom. Lower prices, we see that. Now, of course, you have supply uncertainties. You had the war. You had, in the lower spike there, you had the situation where Iran sent the drones over to Saudi Arabia. So markets spike, but when they reject higher prices, it's very much saying that prices are going lower.
Yeah, it seems like when we had the Iran conflict, it lasted for what, a day or two, a minute, and then it went back to the regular supply demand dynamics that we've been seeing for the past.
It was one late Sunday night for all us traders.
Yep, it certainly was. Let's move along to our next chart here, coffee.
And coffee's even more dramatic because it looked like that was going to be an economic indicator of strengthening. We saw that perfect fourth quarter rally, boom. Now it's giving it all back again. If it breaks these lows, it's really indicating, and if you go back even further, 3-year, 5-year charts, you're seeing that it has much further to go on the downside. Again, you're thinking about this, wait a second, markets should reflect this supply and demand dynamic, but you would think coffee would benefit for the reason that more people work at home, more people are not going out. The demand just is not there.
That's interesting. I feel like everywhere you walk in New York City, everyone has the Starbucks cup. So it's interesting to see that. Moving along to cotton.
Yes. So cotton I found particularly interesting because very economically sensitive, as we'll see later with regard to copper, and I call these all the 6 C's. So you had that downtrend, people call it Dr. Copper, right? It has a PhD in economics. The market goes down when copper goes down. We had the rally, but the rally in copper with the market in the fourth quarter last year was very weak, a huge divergence. Now we have the slowing of the economy and it's just starting to go down. In this case, copper relative to crude and coffee has been a little stronger, but that's something to keep a real eye on, particularly if you cross over those moving averages for your technical people.
Right.
That would be the death cross.
All right, now this one's cotton in particular. Nope, go back to cotton.
Yeah, that was cotton, that's what I was saying. I'm saying copper, when we get ahead, you'll see how fast it declines.
Okay, all right, now let's move along to copper. Yeah, oh wow.
Yeah.
Yeah.
So that's the copper, when I say comparing cotton and copper, the PhD in economics is, boom, that's telling you right now that the economy is getting really ready to slow significantly. U.S. economic numbers in the first quarter going to be fascinating because you have supply chain disruptions. You've got Boeing. Now on top of that, who's going to go? And I ask everybody, if you're a family person, you've got kids, are you now going to take them to the Summer Olympics in Tokyo, which only are a few months away? Supply and demand, I keep going back to that. Just step back and go, is that going to increase supply? And is it going to reduce demand? Those two things say lower prices.
Yeah, I mean, if you look at the last 4 charts, they all look the same. Everything's in the
Yes,
decline.
that's the point.
Yeah, so moving along to cattle.
Yeah.
It's the same thing there.
Yeah, cattle's fascinating. And by the way, right, you had that strong cattle rally in cattle when everybody was talking about, oh, how wonderful Beyond Meat and Impossible Burger and everything, but there was demand for it. Now, boom, same thing. Very economically sensitive because meat's expensive. All indications that the economy is slowing.
All right, our last one here, corn, I would imagine not quite as drastic, but still.
Well, but see, it's been in a long downtrend. Remember, we've had a lot of supply. we would have thought after the phase one signing, you would have gotten a rally in corn because China had agreed to purchase more agricultural products. But if you're shutting down the economy, you're not going to be importing corn.
Right.
And think about all these natural products. They have an expiry date. You can't store all of it. You're going to end up having to dump them on the markets. So in crude, airline fuel is the most expensive. You're cutting down airline, you're going to have to do that. That's why the hedging markets are very efficient, but that's why you've seen a dramatic changing of the front month contract to the back month contract and prices being pushed down.
I mean, fundamentally and technically, this all makes sense. But this week, the major averages are hitting all-time highs. Where's that disconnect coming from?
Well, the disconnect comes from the fact that the stock market has been more and more narrow in the nature of the indices. So, for example, Amazon makes a lot of sense to go up. If you're not going out to go shopping, I'm going to let Amazon get it for me. So, boom. Now that's a high cap stock. It's got a high weight in the indices. It's going to go there. Apple hasn't done anything, obviously, because China's closed down. So then you look at Microsoft, same thing. I'm going to purchase more products online. The cloud is growing as a result of it. Big cap stocks drive the indices. But if you look beneath the surface, a lot of those other stocks have suffered, particularly transports.
Peter, thank you so much for the insight.
Pleasure to be here.
Thank you for joining us on Trade Talks. I'm Jill Malandrino, Global